On the morning of April 6, 1933, millions of Americans effectively woke up as potential criminals. Their crime? Owning gold. What had been a legal symbol of wealth and security just the day before was suddenly transformed into an instrument of crime, subject to federal penalties. This pivotal moment began what many view as one of the most drastic government seizures of private assets in modern history, orchestrated by President Franklin Delano Roosevelt during the depths of the Great Depression. The document that initiated this seizure was Executive Order 6102, and its message was simple, shocking, and absolute. All Americans were required to surrender their gold coin, gold bullion, and gold certificates to the federal government. To refuse was to risk 10 years in prison and a $10,000 fine, a punitive sum equivalent to nearly $200,000 today. The era of private gold ownership in the United States was over. But this unprecedented action wasn't a sudden whim. It was the desperate climax of a years-long global financial disaster driven by the very system America had built its wealth on, the gold standard. For decades, the U.S. dollar had been defined by gold. Under the Gold Standard Act of 1900, the government was obliged to buy or sell gold at a fixed price of $20.67 per ounce. This system was meant to ensure stability, but during a severe economic contraction like the Great Depression, it became a fatal constraint. As the financial crisis deepened, starting with the stock market crash of 1929, prices across the U.S. economy plummeted, leading to crippling deflation. Banks began to fail in waves. This created a vicious cycle. As people lost faith in their local bank, they did the most rational thing possible. They withdrew their deposits, demanding gold or currency redeemable in gold. This was a classic bank run, but on a national and international scale. The Federal Reserve was legally bound to maintain a minimum gold reserve to back the currency it issued. By early 1933, the outflow of gold, both domestically from panicking citizens and internationally from foreign investors fearing a dollar devaluation, had pushed the Federal Reserve's reserves to their legal limit. The situation was dire. The gold standard, the system designed to prevent instability, was now forcing the Fed to raise interest rates to protect its gold reserves, which in turn further suffocated the already collapsing economy. Many other nations, including Great Britain in 1931, had already abandoned the gold standard to give their governments freedom to reflate their economies. The domestic run on gold culminated in February and early March of 1933. In the final week before Roosevelt's inauguration, a staggering $1.8 billion in currency and gold was withdrawn from banks, with nearly two-thirds of that occurring in the final week of February and the first week of March alone. On his inauguration day, March 4, 1933, with the banking system on the brink of total collapse, Roosevelt's first major act was to declare a national bank holiday under the authority of the century-old Trading with the Enemy Act of 1917. This old, wartime legislation was dusted off and reinterpreted to give the president emergency powers over the banking system. This proclamation immediately suspended all banking transactions across the country. Doors were chained, tellers were idle, and commerce ground to a halt. The emergency measure's stated purpose was to prevent further hoarding of coin, bullion, or currency or speculation in foreign exchange. The 4-day closure allowed the government to rapidly draft and pass the Emergency Banking Act. This legislation legitimized the bank holiday and crucially gave the president expansive authority to control the nation's currency, gold, and foreign exchange. It was this legal foundation that would be used to issue Executive Order 6102 just a month later. The ultimate goal of Executive Order 6102 was clear: centralize all monetary gold in the hands of the government. This was the only way to break the gold standard's chain and allow the Federal Reserve to inject liquidity into the shattered economy without immediately triggering hyperinflation or total gold depletion. The government needed to print money to end the deflation and stimulate recovery. And they couldn't do that while every dollar they printed represented a redeemable claim on a finite amount of gold. The order mandated that all private citizens, partnerships, associations, and corporations deliver their gold to the Federal Reserve Bank or authorized agent on or before May 1st, 1933. In exchange, citizens would receive the existing fixed price of $20.67 per troy ounce in paper currency. The order was sweeping, but included a few notable exceptions. A mere $100 in gold coins, about 5 ounces, could be kept for customary personal use. Gold used in industry, profession, or art, such as by jewelers or dentists, was exempt. Gold coins having a recognized special value to collectors were protected, providing a crucial loophole for numismatics. The government's justification was simple and dire. Hoarding gold was considered a selfish, antisocial act that was destroying the economy for everyone else. By removing gold from the recognized and customary channels of trade, citizens were seen as crippling the nation's recovery efforts. Initially, there was some pushback, with the amount of gold returned to the reserve banks in the first weeks being less than the administration hoped, but the threat of severe prosecution eventually led to greater compliance. Once the bulk of the nation's private golds was secured, the second, critical stage of Roosevelt's plan began. On January 30th, 1934, Congress passed the Gold Reserve Act. This act legally solidified the government's title to the confiscated gold and, more importantly, gave the president the authority to reduce the gold content of the dollar. Roosevelt immediately exercised this power by raising the official price of gold from $20.67 to $35 per ounce. This was the pivotal move. The government, which had just acquired the public's gold for the old, lower price of $20.67, now revalued its own massive gold stock by over 69%. This maneuver generated a nearly $2.8 billion profit for the Treasury. This profit, which came at the expense of gold owners, was placed in a stabilization fund to control the foreign exchange rate and, critically, was used to finance New Deal recovery programs. By devaluing the dollar, American exports became cheaper and more competitive abroad, helping to reverse the debilitating deflation that had plagued the country. In the opinion of many economic historians, this decision to abandon the rigid link to gold and allow reflation accelerated America's recovery from the Great Depression, proving the gold standard had indeed been the anchor holding the economy down. Not everyone accepted this profound shift quietly. The Gold Reserve Act also required the government to nullify all gold clauses in public and private contracts. These clauses, common in bonds and mortgages, guaranteed repayment in gold or the equivalent amount of paper currency at the former gold price, protecting creditors from devaluation. Suddenly, all those ironclad contracts were deemed illegal. The constitutionality of these actions was immediately challenged in a series of landmark cases before the U.S. Supreme Court, known collectively as the Gold Clause cases of 1935, Norman versus Baltimore and Ohio Railroad, Nortz versus United States, and Perry versus United States. In a narrowly divided 5-4 decision, the Supreme Court upheld the government's power to abrogate the gold clauses in private contracts, asserting that Congress had the constitutional authority to regulate the monetary system. However, Chief Justice Charles Evans Hughes, writing for the majority, delivered a stinging rebuke to Congress on the matter of government bonds, stating that Congress had erred in nullifying its own contracts. Nonetheless, the court ruled that bondholders could only recover nominal damages, effectively making their legal victory meaningless. The government's authority over the nation's monetary policy was affirmed, despite the furious dissent of Justice James C. McReynolds, who warned of financial chaos. For 42 years, Executive Order 6102 and the Gold Reserve Act made it effectively illegal for Americans to own monetary gold. While the domestic gold standard was dead, the U.S. remained on an international gold exchange standard, the system that formed the basis of the Bretton Woods Agreement after World War II, where foreign governments could still redeem dollars for gold at $35 an ounce. This international link was finally severed by President Richard Nixon in 1971, marking the final end of the gold standard era. It wasn't until December 31st, 1974, that President Gerald Ford signed a bill legalizing the private ownership of gold in the United States once more. Executive Order 6102 remains a powerful, often controversial, case study in American history. It illustrates the government's willingness to use extreme, almost despotic powers in a moment of existential crisis, fundamentally altering the relationship between the citizen, their wealth, and the state. It serves as a permanent reminder that in the face of financial collapse, the very definition of money is not absolute, but a matter of law.